Hello and welcome to Looking at the Markets with David Modell. Today we're going to talk about trading the 50-period moving average. And before I get started, I just want to let you know that if you need more help, if you want some help putting together a trading or investing plan, I do offer coaching. You can email me for the coaching at davidmodell@gmail.com. So let's get into it. Trading the 50-period moving average. First, I want to talk about the SMA versus the EMA. What's the difference when using the 50-period moving average? If you prefer a true moving average with equal weighting or importance given to the last 50 candlesticks closing prices, then you can use the simple moving average or SMA. If you prefer a weighted moving average with more importance given to the most recent candlesticks, then you can use the exponential moving average or EMA. So which 50-period moving average should you use? It's up to you whether you want to have more importance given to the recent price action or whether you want all of the last 50 closing prices to be equally important. Now, the ideas that we're going to be talking about here can be applied to any time frame. 1 minute candlesticks, 2 minute, 5 minute candlesticks, 1 hour, 1 day, 1 week, etc. Okay? So no matter which time frame of candlestick you use, these ideas I'm going to be speaking about could possibly apply for any of them. Okay? But whatever you do, please be aware that I don't necessarily agree with these ideas. Everything I'm going to be saying today, I don't necessarily agree with them. They're just very popular ideas that a lot of people believe in, and I want to relay them to you so that you can decide for yourself whether they're good or not. Okay? So I don't necessarily agree with these ideas, but they are very popular, and you could test them out with demo trading, where you're not using any real money to see if they work for you, okay? So please do not just start using these ideas with real money, okay? Try them out with demo or virtual trading first for a while, see if they work for you, and always respect your stop losses and use, later on, if you choose to use real money, make sure you use very small amounts of money, okay? And those stop losses will also help you to not lose too much. Hopefully. Okay, no guarantees there though. All right, but start out with demo trading to see if these or any ideas work first before you really try them out with real money. Okay, so concept number one with the 50-period moving average. One, if the most recent candlestick on the chart is above the 50-period moving average, then the bulls are in charge. So only be a buyer, never be a seller, and never go short when the candle is closing above the 50-period moving average. All right, so let's take a look at that. I'm going to look at tradingview.com, and I'm going to look at a chart of the daily candlestick chart, 1 day candlestick chart of Apple stock, okay? So as you can see, the most recent candlestick is definitely above the 50-period moving average. And I chose to use the EMA, by the way, instead of the SMA. But as I mentioned, they're both fine. It just depends which one you want to use. So it's above. And so the idea here, the popular idea here, is that you only want to be a buyer whenever the candle has closed above the line, above the 50-period moving average, okay? The idea is don't be a seller or a short seller here. And if you go back with the candlesticks, you may notice in many instances that when it is above the line, I'm not saying that the line is magic or anything, but there are instances when it's above the line, and if you went long, if you bought, you would have done quite well. It just kept going, and you could hold on to it, right? You could have held on to it until it came back below it, all right? It does not happen like that every time, but that is an interesting way to let your winners run, or at least not to be on the wrong side of the trade. That's the idea here, okay, according to this method, all right? As long as it's above the line, don't be a seller, be a buyer or hold on to it. That's the idea, okay? Number 2, if the most recent candlestick on the chart is below the 50-period moving average, then the bears are in charge. So only be a seller or short seller, never be a buyer. Okay, and so the most recent candlestick for Apple here is not below, but when it was below, then it's interesting. It came below here, retested it, but came below again, and it would have been a good period to sell or to go short because it kept going down. Okay, it does not happen like that always, but it's an interesting idea that when the candlestick closes below the line, then these sellers are in charge, and you don't want to be a buyer, according to this method. On the other hand, there are always two sides to every story, right? On the other hand, the farther away you move from the 50-period moving average, the more likely it is that the price will snap back to that line. That's an interesting concept. So yes, when it's above the line, according to this method, you don't want to be a seller, you want to be a buyer. But when it gets really, really far above the line, so let's take a look. When it starts to get really stretched out, when the distance, the white space between the line and the candle starts to get wider and wider, then the more likely it is that it's going to snap back to the line. All right, so the distance was narrow here, but it got really wide here between the line and the candle. And pretty soon afterwards, it snapped back, the candles snapped back to the line, to the 50-period moving average, okay? So if it gets really stretched above, okay? And also to the downside, look at this. When the candle was far below, this candle closing price was far below the line and it snapped back to the line. That's really interesting, okay? So to repeat, the farther away you move from the 50-period moving average, the more likely it is that the price will snap back to that line. All right. So if it's far above, do you want to be a seller? No, not according to this method. But you may want to take some profits. You might not want to be a buyer at the very least, because it's so far above the line, you see, which means that soon maybe it's going to snap right back down to it. It might be overextended or stretched or exhausted. The move could be just exhausted. Therefore, these are some conclusions. 4, if the candlesticks go below the 50-period moving average, but then go back above it, that could be a time to consider buying, okay? And as you can see in Apple stock, all right, let's take a look. Apple stock went below the 50-period moving average, but then came back above it, so that could be a time to get in. It might retest it, okay? And sometimes you're going to get stopped out, all right? But as you can see back here, when the price of Apple stock, here it is, went below the 50, but then went back above it, okay? And then you stayed in the trade. It tested you here, but it didn't go below it. And you just stayed in the trade. You could have done pretty well, right? Number 5, but after that, if the candlesticks get stretched far above the 50-period moving average, which we talked about, it might be due for a snap back to the 50-period moving average, okay? When it goes too far above, when there's too much space, too much white space between the candle and the line there, it might be due to snap back soon to the line, might go down. Therefore, that could be a time to consider selling, okay? So on one hand, you don't want to be a seller above the 50 unless perhaps it goes so far above the 50 and there's a lot of space there that maybe if you took a long position when it first went above the 50 and you did well, maybe it's time to consider taking some profits because you don't want to be greedy because it might snap back. And number 6, if you see other exhaustion signals, such as diminishing volume, okay, let's say, I don't have the volume bars on here, but if you had volume here, okay, it's going up, 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 there's a wider and wider space now between the candles and the line, and you see the volume bars start to go down, down, down at the same time, maybe the buyers are starting to get exhausted, okay? Maybe it's time to consider taking profits. Or other exhaustion signals, such as a diminishing volume or a doji candlestick, something like that. You can look at the shapes of the candlesticks. Like here's a doji right here. Isn't that interesting? Look at that. I don't know if you could see it, but there's a doji candle. There's hardly any body. All right, it's like a flat body on the candle, and there's an upper and lower wick. Kind of interesting. Maybe that's a reversal signal. All right. That could be considered confirmation that maybe it's time to sell, or at least take partial profits or full profits. Okay. So those are some concepts for trading the 50-period moving average. Whatever you do, test it out with demo trading. Make sure it works for you. Always use small position sizes. Respect your stop losses. Be safe. Don't get greedy. Okay. I don't necessarily believe all the things here. It's just ideas that I'm trying to relate to you. I'm going to keep on bringing you ideas. And if you want more coaching, more personalized help with your trading or investing, you can contact me by email at davidmodell@gmail.com for the coaching. Thank you so much for watching and listening. I will talk to you again soon.